Thank you for joining us. It's another edition of Your Business Nigeria. Here are the highlights for today. Fuel subsidy hits 1.59 trillion naira as refineries rehabilitation gulps 54.6 billion naira. Federal government investigates Philip Consulting United Bank for Africa for breaching Nigeria data protection regulation. China pares back holdings of U.S. treasuries for 7 consecutive months. Well, on our interview segment on the show this Tuesday, our first conversation focuses on the latest report, that's Nigeria's inflation rate, as the country records a 17-year hike in inflationary pressure. 19.74%. That's very high. We would be analyzing the impact of this on the already fragile economy and whether or not rate hikes have had an impact on reining in the pressure. For the second part of the show, we will look at Nigeria's subsidy regime. You saw in the headlines what we are spending on subsidy, how much of an economic cost the nation has to bear so far and will continue to bear while it lasts, and then calls on the federal government to explore what they term systematic subsidy removal program. What does this mean? How effective will it be? Welcome to the show. Let's start with some news making headlines across the world of business. The federal government, through the Nigerian Data Protection Bureau, says it is investigating Phillips Consulting and the United Bank for Africa PLC for violating the Nigerian Data Protection Regulation. This is according to a statement issued by the Bureau on Monday. According to the Nigerian Data Protection Bureau National Commissioner, Dr. Vincent Olatunji, the complaint against Philip Consulting is in connection with the activities of an online lending platforms who willingly breach the privacy of citizens, whilst the investigation of UBA PLC pertains to allegation of infringement on the governing principles of data protection. The Bureau further warns all data controllers and processors to refrain from all forms of data processing that are detrimental to citizens, the economy, and the security of Nigeria. Earlier in June, the Bureau had said it will investigate Wema Bank and KC Gaming Networks, also known as Bet Niger, over an alleged data privacy breach. The Bank of Industry, in a fresh announcement, says it has successfully completed a landmark €1 billion guarantee senior loan facility to further enhance its capacity to deliver on its mandate, in line with President Muhammadu Buhari's economic diversification agenda. The BOI, in a statement, said the initial mandate led arrangers and underwriters for the second senior phase of the transaction, led and coordinated by the African Finance Corporation and Standard Chartered Bank, also including Abso Bank Limited, acting through its corporate and investment banking division, First Abu Dhabi Bank, PJSE, First Rand Bank Limited, London branch, acting through its Rand Merchant Bank division, Merchant Bank PSC, Netbank Limited, London branch, and SMBC Bank International PLC. The African Export-Import Bank, that is the agent of the bank. The managing director of the BOI, Mr. Kayode Piton, notes that at a time when international capital markets are shut to many borrowers and when capital is prohibitively expensive, through this innovative transaction structure and the AFC guarantee, BOI is not only able to raise liquidity, but also able to diversify its funding sources and attract new lenders. This is the 5th time BOI has successfully raised funds in the international market since 2018. With the conclusion of this transaction, total fund raised by the bank from 2018 to date is in excess of $5 billion. Well, let's start our first conversation for the day. We'll focus on rising inflationary pressure Nigeria is faced with and how this exacerbates the pressure the already fragile economy faces. We had one of the biggest headlines from the quarter coming yesterday, which beats economists. Of course, the forecast of how fast we would see inflation spiking following the move by the Monetary Policy Committee in its July meeting to raise rates as part of measures to rein in inflation. For some, this is almost a predicted outcome where not much will change and there are external elements that are beyond the nation's control, talking about imported inflation and for the fact that the nation remains a heavy consumption base and production is yet to hit the baseline to support any recovery. Now, within the last 24 hours, reactions have trailed the 19.74% spike in the consumer price index for the month of July. We also see the food inflation rate in July recording an almost insignificant decline of 22.02%, reflecting the month-on-month movement of 2.04% from 2.05% recorded in the month of June. Well, joining me now to analyze the inflationary pattern over the course of January to July timeline and the fueling factors responsible for this inflationary spike. And more of this, of course, I'm being joined by Mr. Justin Chukwu, who's the Chief Executive Officer of Cowrie Assets Management Limited. He joins me from the United States of America. Thank you so much for your time. Despite the time zone and all of that, you're able to join us. We don't take this for granted. Thank you so much, Mr. Chukwu. It's good to see you.
Thank you, Tolu. It's always my pleasure to join you. How is our country, Nigeria?
Well, we're trying, we're faring, we're still living, we're alive and hopeful. Well, let's get talking. But you know, I always like to start this way. What were you expecting? Because some said, or yesterday I was speaking to Andrew Nevin, and he said it specifically that this is really worrisome. I don't know if it also comes to you that way, or were you expecting this sort of hike in inflation figures?
Yeah, Tolu, I was expecting further increase. I didn't expect it to get to 19.64%. I actually thought we will see another 50 basis point increase, but having a more than 100 basis point increase again is actually worrisome. For me, if you recall, I had said at your program that the current measures being put in place by the central bank will not curtail the inflation because it's not addressing the root cause of the inflationary pressures. And if you cast your mind back to where we're coming from, when the monetary policy rate was increased by 150 basis points in May, recall that April inflation was just 16.82%. Then between that time when we increased monetary policy rate by 150 basis points, we subsequently increased again in July by 100 basis points. And yet, June inflation came at a rate of 18.6%. And now we're dealing with inflation rate of 19.64%. So clearly, those policies adopted by the central bank are not addressing the root cause of inflationary pressure and will not necessarily curtail the current inflationary pressure we're witnessing.
It's looking like there is still no synergy, and this remains very important at this time, particularly as we move into an election year. More is coming from the monetary side, and less seems to be coming from the fiscal side. How do we strike a balance here?
Well, let me put it more succinctly. The issue is beyond synergy. The issue is that we need to address the inflationary pressure from its root cause. If you further disaggregate the inflationary pressure, which you did in your introductory statements, food inflation was 22.02%. Food accounts for more than 50% of the consumer basket in determining the all item inflation. And if you take out food inflation, you realize that core inflation was only 16.75%, which means that if food prices had actually moderated, we should be talking about inflation moderating. So the problem we have is issue of food, and we have to look at where is it coming from. Further looking at the food inflationary pressure, you realize items like bread, cereal, tuber are some of the major propellers of the increase in food inflation. Take out those items. Take, for instance, wheat and bread. I mean, bread is a derivative of wheat. And then you have cereals. These are imported items that are imported because Nigeria we're not producing enough food. Today, look at tuber, which is produced locally, and other items that are produced locally. Why is their price going up? Because we have heightened level of insecurity in the country that is constraining food production. If we are to address this security problem in the country, you will realize that food production will improve and there will be food substitution. People will move away from cereals and bread and then eat other locally made food if those food items are cheaper. So that's a major propeller of the food inflation we're witnessing today, and which is a major contributor to the inflation we have. Going further to the core inflation, you look at the issue of energy costs, and particularly the pass-through effect of the depreciation of the local currency. I took a look at what is happening to other African countries that are producing major oil producers. Second to Nigeria is Angola. You realize that inflationary pressure in Angola is moderating. HA in Angola has moderated from about 640 kwaza per dollar to just about 420 kwaza per dollar. So which is the pass-through effect of that, we've seen a moderation in inflation rate in Angola. And Angola is the second largest crude producer in the country. But the converse the case, because we're not producing enough crude as to enhance our foreign exchange earnings and stabilize our exchange rate. So part of the problem we're facing today in inflation is the pass-through effect of the depreciation of the local currency, which is affecting most of the imported items. So issues are beyond alignment are the fiscal authority doing what they should do? Are we fighting inflation, talking at the root cause of the current inflationary pressure? Or we think that inflation is driven by money supply only? Yes, there's excess money supply, but central bank has actually withdrawn that through debiting the banks with cash reserve ratios. But beyond that, look at the issues of exchange rate, pass-through effect of exchange rate, cost of inflation driven by food items, and those have to come with addressing the issue of insecurity in the country. If we don't address that, we are running after a horse that has already bolted away.
Well, let me welcome our viewers on DSTV. Yes, we were live broadcast from Rivers State, but now we are back live on all platforms. DSTV, GoTV, so we can continue this discussion, particularly this DSTV channel 418. So let's go on with our discussion, Mr. Johnson. Now, this is worrisome, and the shift in food inflation, even the report reads, it looks so insignificant, saying there's some reduction in some prices of some tubers and all of this. What do you think is responsible for that insignificant reduction in that space?
Well, those could come from lag effect, because this is not a harvest, and part of it could come from the seasonal changes coming from harvest periods. I remember this is in the southern part of the country. This is a new yam period, so new yams have come out, and because there is surplus supply of new yam, you could actually understand why the price of tuber may have moderated. So that's a seasonal impact, and like you said, it's inconsequential. But if you look at what overall impact we had on food inflation.
Let's now move on to what we expect the MPC, because the last meeting in July, the governor said it clearly that if this continues, they will continue to also increase rates. If that happens, what do you think will be the impact of that across on the economy?
We should know that continuous increase in rates is we have a definite single outcome, and that we're going to push the economy back to recession. And it's very simple. Your increasing rate has not moderated inflation. It has not led to an increase in food production, as to lead to reduction in food prices. It has not stabilized the exchange rate, as to lead to lower a transmission effect of depreciation of the local currency. It has not enhanced your foreign exchange earnings, as to boost your foreign reserve and help you stabilize your exchange rate. So if you continue to increase in interest rate, what will happen is that you are also pushing further inflation, because the producers will buy money or buy funds from the financial system at higher cost, and they will pass it on to as part of their cost of production, which will further heighten inflation pressure. But that further heightening of inflation pressure will mean that for an average consumer, their standard of living will further deteriorate, because the purchasing power of their income will decline. And then what happens is that their consumption of most items will decline, and producers will no longer have enough demand for their goods. And if they don't have enough demand for their goods, they will slow down their production, they cut back on production, and they will lay off staff. So we are basically working towards a certain shutdown or decline in the level of productive activity in the country. And that's exactly what central bankers are ignoring, that the current approach to fighting the current inflationary pressure will only lead to shut down or slow down economic activities as a result of higher cost of production for manufacturers, lower demand for goods and services, and shut down or slow down in employment. And when that happens, we're going to basically walk into a global recession. And it's only when we achieve that recession that you're going to see a reduction in crude prices, which will begin to reverse the current inflationary pressure. So the approach for me is wrong. The approach should have been, let's look at how do we improve those input factors, those input material that are driving up inflation pressure. Nigeria is actually a unique case because one, we can increase crude production like Angola is doing, and therefore enjoying slower inflationary rate, stronger currency. We can do the same thing that Saudi Arabia is doing, which is enjoying inflation rate of just 2.7% per annum. And the reserve is increasing, currency is strengthening. So if we are in the situation where we are now a producing country, we should adopt the approach that producing countries have adopted, and which is why most of the producing countries are smiling to the banks. They're having more stable economy, they're having lower price levels. Russia is a classical example. Russia started the war, but Russia's inflation rate has moderated, interest rates are moderated, and the concerns of the Russian monetary policy managers is we do not want price of Russian export to become too dear to the international community that they no longer import from us. So we need to bring down even our cost of goods as to encourage export of more Russian products. Because inflation has been tamed in those countries as a result of increase in foreign exchange and stable exchange rates. But unfortunately, ours is the reverse. We can address most of these issues by addressing the issue of insecurity in the northern part of the country and addressing crude production in the Niger Delta regions. So for the Monetary Policy Committee, I think they must recognize this, and they must go back to the fiscal authority and say, look, these are problems are coming from structural defects in the economy. You can no longer continue to fight it, because continuing to fight with higher increase in interest rate will lead to unintended negative consequences.
Now, some of the drivers or inflation drivers, I know we've identified some in your earlier submissions, but I want to focus on 2 or 3 of them. That's transport cost and, of course, logistics challenge, and the big one, the exchange rate depreciation. We've seen what's been happening around these 3 factors, and it seems not to be abating. How do we do it? Some of them are beyond what we can control. We are an importing nation, so we have issues, of course, with FX. Even airlines can't repatriate their funds at the moment. So where do we go from here?
You know, let's look at the items you mentioned. The issue of pass-through effect of depreciation of the local currency is coming, like I said earlier, it's coming from the fact that we're not earning enough revenue from crude oil exports. And that's also linked to the fact we're not producing enough crude. And that could further be drilled down to the fact that we are having pipelines being breached, we're having shut-in, oil producing companies can no longer just produce and pump products into their pipelines and take them out at the export terminals. I understand the level of reconciliation had dropped to just between 20 and 10%. So in effect, if you pump in 100 liters of crude in a pipeline, you get about 10 to 20 liters at the export terminal. We must address that. That's the core of our problem. And if we do that, we're going to have stronger reserve, stronger currency, and then the impact of even the fact that we are an importing country will moderate. Because once your balance of trade is positive, once you export more than you import, your foreign reserve will improve, and then what happens is that your currency will strengthen. The challenge we have, because we must consume a certain level of goods and services, but we're not exporting further to compensate for that. Then the other issue of supply chain bottlenecks. I'll take it from 2 perspectives. The supply chain bottlenecks associated with importing from China as a result of the lockdown in Guangzhou and some other countries because of China's zero tolerance for COVID has some impact, because China is our largest import market. Of course, you can't whisk away that. So we must live with some element of that. But it wouldn't be that pervasive as to lead to a 19.64% increase in inflation rate. The other aspects of issue of food inflation, we've talked extensively on that. And I believe we as a country should take measure. I mean, today I'm happy to hear that we're fighting back. The government decided to fight back. So it simply means that the government initially decided to hold back against the terrorists and whatever you call them. And now we decided to fight back. And do not think that some ragtag army has the capacity to overwhelm the Nigerian army. I think there's something that is missing. And I'm quite happy. I'm hoping that we've taken the decision now to fight back and restore sanity in our country. If we do that, we're going to see production of food items increase materially. Nigeria eats substantially locally made food. The impact of wheat on bread and other cereals will be moderated if we're producing enough of our locally made food. So the key thing is that the problem we're facing are problems we can largely solve. In terms of energy cost, particularly cost of transportation, of course, that's going to take some time for us to address. The reason is that we're not refining any single liter of crude today in the country. So we must live with imported imported diesel and the price of diesel. I looked at the website of a Nigerian Bureau of Statistics about, they say a liter of diesel is about 746 naira per liter, and fuel is about 175 naira or so per liter. These are facts we have to leave because of our previous decisions not to liberalize or deregulate the downstream sector and allow refineries to come up. So we must live with that for some time until we take the bold decision to address that. So if we're only dealing with logistic issues, which are issue of transportation cost, because if you remember that most of the trucks or articulated vehicles that move goods around drive on diesel, and diesel is deregulated. And like I said, NBS said it's about 746 naira to liter. And even to worsen matters, we don't have other intermodal transport system. The rail systems have been shut down between Kaduna and Abuja. That of Lagos to Ibadan, I understand, has been reduced to 1 or 2 shuttles in a day because of price of diesel. So we're left with only one choice of transporting our goods through trucks, and those trucks drive on diesel, and diesel price is deregulated. So that is an element we must live with. But my position is that if we address the issue of food inflation, which to some extent we moderate if we have food production back to our food producing beds, and we address the issue of insecurity in the Niger Delta, breach of pipelines, stealing of crude, and we restore crude production to about 2 to 2.3 million barrels a day, we are going to see substantial improvement or reduction in current inflationary pressures.
So as it is, we might continue to see this hike in inflation that's continued increase. Does this mean anything? Talking about recession, is it inevitable? The global recession, and of course, even in Nigeria, it looks like it's inevitable.
Yeah, well, like I said, if the monetary policies globally, central banks in US, in Europe, continue in the current trajectory, they are going to walk to the global economy into a recession. And that's the only point where the demand for crude will decline, price of crude will decline. So energy costs, which is the major propeller of current inflationary pressure globally, will moderate. The approach for me should have been that the Western countries should begin to retool their refineries and look for alternative crude supply sources. If Nigeria could be encouraged, whatever that encouragement will entail, to improve production, we have the capacity to scale up by about 1 million barrels a day. And remember that Russia is producing about 10 million barrels a day. So if a country like Nigeria can scale up by 1 million barrels a day, get countries like Libya to scale up, and probably if the OPEC countries can improve production by about 5 million barrels a day, crude prices will drop even if the war in Russia and Ukraine continues. And that, for me, is the approach to begin to address the energy cost instead of just increasing interest rate. Increasing interest rate will lead to gradual slowdown in production consumption in Western countries, slowdown in production, retrenchment of workers, and the global economy will go into recession. Of course, Nigeria will not escape it because we're not even addressing the core of our own problem.
Indeed, I must appreciate your time. I've been speaking to Mr. Johnson Chukwu, who's the Chief Executive Officer of Cowrie Assets Management Limited. Thank you so much for spending your early hours with us, joining us from the United States of America. We appreciate this.
My pleasure.
Yeah, we're still on Business Nigeria. Let's delve into our second segment as we look at the latest developments in the oil market. Pricing of the global commodity and the subsidy regime in Nigeria despite the implementation of the Petroleum Industry Act. Latest data on the amount spent on subsidy on fuel by government subsidizing the commodity with 1.593 trillion naira between January and June this year. The Nigerian National Petroleum Company Limited pumped 54.6 billion naira into refinery rehabilitation during the 6 months period. It is clear that the current fuel subsidy regime debilitating impact on the nation's fiscal fragility cannot be overstated. So far as part of measures to counter this phenomenon, there are increasing calls to the federal government to explore a systematic subsidy removal program that will cushion the impact of the nation's vulnerable population through a well-coordinated and effectively transmitted social protection regime. Joining me to look at this development in the oil market and subsidy regime, and of course, an exit plan that Nigeria can explore, I have Noel Okodi. She's a senior energy analyst with Stairs Business. Noel, it's good to see you. Good afternoon. Thanks for your time.
Good afternoon. Thanks for having me.
Yes, when I read yesterday about a systematic way of taking away subsidy, well, many would have said that when the price of crude was down, Nigeria would have just done the needful. But at the moment, it's too late to do that. So, what do you understand by systematic removal of fuel subsidy? Looking at what this is taking away from government day by day.
Thanks for that question, Tolulope. Well, like you said earlier, the petrol subsidy is costing us a lot of money. So we've spent 1.593 trillion naira in 6 months compared to 1.57 trillion naira in 12 months last year. So this year we're probably going to spend more than 3 trillion naira on petrol subsidies alone. And that just tells you that it's unsustainable. So from data that we've seen that the bottom 40% of Nigerians only consume 5% of Nigeria's petrol. So that means that the petrol subsidy isn't actually benefiting the poorest Nigerians. Rather, it's middle class and upper class Nigerians that are benefiting from cheap petrol, people that can afford to pay for petrol. So I think a phased removal, like we've said before, a phased removal is the best option where we increase the price of petrol gradually. I think right now petrol prices have actually increased because it's difficult for the government to keep up with the subsidy. So right now, petrol in Nigeria is 179 naira per liter from 162 that it used to be. And it would be wise to just continue gradually increasing petrol while also providing some sort of benefits or stimulus packages for the poorer Nigerians who don't even benefit that much from the petrol subsidy in the first place.
Some things, many believe that a lot needs to be done, particularly at this time when the issue of trust comes in. We've gone this route before. I know we've talked about this before. But what are these things that we think government should do? Many will talk about maybe having buses that will run via gas, looking away from all of this. What have we started planning at all?
So we haven't seen any of the plans materialize. We know that the government has announced, or they announced a few years ago that by the end of 2019, I think, 1 million buses in Nigeria will be running on gas, but we haven't even seen one. And this is where this trust factor comes in. So the government says one thing, but they don't follow through. So they say 1 million buses will be running on gas. 2022, 3 years later, we haven't even seen one. And that's why when they say something, it's hard to believe them. So even if they said they were going to remove the subsidy and use the money to develop Nigeria and invest in education, healthcare, and even capital projects, roads, transportation, it's hard for us to believe them because that track record isn't there and they haven't built that trust that they should have built over time.
Now, taking it from there, we're not getting even enough funds from the sector. Well, issues around theft and all of that, which have been able to support the economy. Another very important question I would ask you is, we see a little bit of deliberate efforts now, very concerted ones from the NNPC and the likes, going after these guys, doing all of this bunkering, illegal oil refining, vandalism, and all of that. How well do you think this? Where will this take us? Do you think that we are getting it right, or it's still a gradual process?
Well, I would say that we have to, I guess, applaud the NNPC for finally making a move because oil theft has been in Nigeria for years, but this is the first time that we're seeing any proper effort from them. So they launched an app to where people are supposed to report incidents of theft and vandalism. They've also said that they have installed cameras at production points and that so any oil that leaves Nigeria will have a unique number so that if someone steals oil and sends it to an international refinery, the international refinery can check whether that oil was illegally sent or legally sent. All these measures are, I guess, a good stepping point, but they are not going to solve theft. First of all, with the app relies on people actually wanting to report incidents of theft. And I don't know about you, but I don't know how many Nigerians would be willing to report incidents of theft. And I think this is where this trust issue comes in because for normal Nigerians, they feel like even if even if the oil money wasn't being stolen or oil wasn't stolen, would the government use the money to develop the country? And if that certainty isn't there, then there's no incentive for people to even want to report incidents of theft. With the cameras at the production points, Who are the people watching the cameras? Who are the people watching the footage? Who are the people that are going to go and check when this theft happens? Will they know the exact location where? And even the other solution with putting unique numbers on oil that is sent out of Nigeria, it just doesn't seem enough. It's just not enough to deal with the scale of theft, because we've said that 400,000 barrels of oil per day is stolen in Nigeria. That amounts to like $1 billion. And that's not $1 billion in a month. That's not a small amount that we should just think that an app is going to fix for us. There needs to be more investment into smart pipelines, sensors, and just better security all around for our pipelines and even for exports.
Clearly, this shows that this is not just a job for just anybody. Some professionals actually will be involved in this, because it's not just you going somewhere and just rupture a pipeline and think that you could just get this crude. This really needs to be addressed holistically. The way I totally agree with you. It's beyond all of this that we're talking about. But let's go back to gas and talk more about gas. The minister says it's the decade of gas. We want to focus on gas. But do we have that infrastructure to take advantage of both our proven and unproven reserves?
Exactly. We actually don't have the infrastructure. And that's because the commercial track isn't right. So right now in Nigeria, gas is subsidized, like local gas supplies. So the major consumers of gas are electricity. Actually, electricity is the major user of gas, because 80% of Nigeria's electricity comes from gas. But the problem there is that because the generation companies aren't liquid because of the power sector issues, they can't pay the gas suppliers to now expand their capacity. And that just means that Nigeria's gas, downstream gas sector, sorry, not downstream, Nigeria's gas sector generally is just not growing. It's not growing fast. And especially now that gas demand is so high. And even another problem is that even the NLNG that converts gas to liquefied natural gas and exports and gets dollars for Nigeria, because of the upstream issues with vandalism and theft, the NLNG is not producing enough gas. And so we have two issues there, where the commercial aspect of the Nigerian power sector is affecting the gas supply chain. And then the other issue where upstream vandalism and theft are affecting gas supplies to the NLNG. And we're also not getting enough export revenue from gas. So there are major infrastructure issues there.
Brilliant stuff as usual. Let's look at the NNPC. Of course, now a limited liability company. Well, that's what is happening at the moment. And they need to make money because they have to be accountable for 200 million Nigerians. That is what we've put the CEO, Mr. Mele Kyari, put him to test to see how well he can run that office. But we see this new drive for investment in the oil and gas space. A deal was signed sometime last week. A lot is being done at the moment. What do you think? It seems like it's a new dawn for the oil and gas industry. What do you think to that?
Well, I think that saying that it's a new dawn, I think it's too soon to say that it's a new dawn, because you know that the NNPC doesn't have the best reputation. But we're watching them and we're seeing how things are unfolding. With regards to the new deal that they signed, that's an improvement. So we now have the renewed contracts with some international oil companies for our deep offshore oil assets, and that's an improvement. And we could see more investment in the short to medium term in Nigeria. But on the other hand, we still have issues like SEPLAT, where the government is between the regulators and the NNPC, they seem to be dragging the approval of SEPLAT buying off Mobile Producing Nigeria Unlimited. And that's just a bad sign for investors. So on one hand, they seem to be progressive. On the other hand, they are regressive. So it's a bit difficult to say that it's a new dawn at the moment.
Indeed, I agree with you that it's too early to say that. And those kind of issues, talking about the SEPLAT, ExxonMobil, NUPRC intervention, federal government's intervention, the minister himself coming to say this would happen, and all of those flip-flops. What message does it send with regards to our oil and gas space to international investors. I am worried about what they think about us at the moment.
And I think you're right to be worried because, so like we've said, Nigeria's upstream oil sector hasn't been the most attractive to investors. So one of the reasons why the PIA was brought in was because between 2015 and 2019, we only attracted 4% of the investment that came into the African oil and gas sector. And that's shocking because Nigeria is the top oil producer in Africa. So you'd expect that we should get more. But then, so fast forward to after the PIA, and then we have IOCs leaving, and Seplat wants to buy ExxonMobil's Mobil Producing Nigeria Unlimited, the company. And then you have, like you said, the president, one day he agrees, the next day he disagrees. The deal was announced since February, and now we're in August. We still don't know which way is up. Seplat is still unsure. They released a statement that they hadn't been informed officially that the deal had been rejected again. And all this just creates investor uncertainty because if I'm an investor and I want to invest in Nigeria's oil sector, I want to see what's happening there. What's the likelihood of me getting approval for my deal? And then I see that I don't even know what is going on. Like nobody seems to know what is even going on with the approval process. It just discourages investment, definitely, because if the approval process is taking so long and is so unclear, then what happens if Seplat is even successful? Does that mean that one day somebody can come and say the deal is off? Like, it's just very uncertain, and it just means that investors will not be encouraged to invest in Nigeria's upstream oil sector, at least the onshore and shallow water sectors.
Considering the fact that a lot has been put into this deals, the signings, and all of this before they got to this point, it's really not a good one. Finally, before I let you go, the refinery rehabilitation. I'm happy on that word, rehabilitation. It's not a turnaround maintenance. It's a total rehabilitation, the Port Harcourt refinery, and we expect it to come on stream later this year or early next year. What are your thoughts?
Well, my first thought is that this isn't the first time that they've said the refinery is coming online at the end of the year or next year. It seems like every year there's news that year would be the year that we'll finally have functioning refineries.
Time around, yeah.
So this time around, I'll just say that we'll believe it when we see it because the track, like we said, the track record with the government isn't great. With the NNPC, we know that even as the refineries are not working, they're still paying salaries for staff. They're spending a lot of money keeping the refineries running when they are not even running. So I think that it will just take time for us to see what happens there. I actually cannot say that we will have functioning refineries by the end of the year.
All right, let me allow Noel Cody go. We'll keep a tab on them, and I'm sure we'll be here again, God willing, to talk about it if truly it becomes functional. I really appreciate your time. I've been speaking to a senior energy analyst. She's a Stairs business. Noel Cody, do enjoy the rest of your day, and thank you for always being there for us on the show.
Thank you.
But it's that time to talk markets. And of course, my colleague, Efenge Kop, is in the house. And I have joining me via phone, equities trader, Planet Capital Limited, Mr. Paul Osm. Mr. Paul, the market is positive. The all-share index is high, 0.15%. Well, not really, not very significant, but at least it's positive. How does this come to you? What's your reaction to this?
Well, today there was, I think it's Blacksmith gained 2.63%, and most of the heavy high-cap stocks in the market did not record any significant price change. So Blacksmith, which controls a significant proportion of market weight, was capable of pull the market up by this margin of 0.16%. And this is coming at a time wherein we just saw inflation numbers which came out for last month of July, 19.64%, which is not a good news. The fear now is if there may be further rate hike by the central bank in subsequent monetary policy meetings, I don't understand that market sales gains, we always just for a marginal gain. We don't think that these gains will be sustained. We just think in the future days ahead, some few more days of bearish sentiments and some few days of market gains. So we see anticipate that by the time results of the companies that are paying dividends, assets, Zenith, Guarantee, GTCO, and UBA, when they will be published, that would help to spike up market confidence.
I must thank you so much for your time, Mr. Paul Ozom. Interesting submission from you there. Do enjoy the rest of your day.
Thank you.
Effiong, take it up from where he stopped. And of course, I think you're also taking us through the African continent. First, let me ask you, what's Kenyan market looking like today after the elections?
It's really interesting. Kenyan market is trading in the upper territory.
Wow, it's green.
Yes. Their election this time, I think it was devoured of real violence.
Yeah, of course.
So, honestly, I think investors, they were so happy. I found the Kenyan market, is moving 0.10%.
Wow, great
upward.
stuff.
Yes,
great.
Yes,
great.
After the announcement of the new president. But when we come back to the Nigerian markets, I think it's a bit of a relief that we have this positive trading after nearly 1 week of low trades. But that is, the question is, will the market sustain it? And that is where the doubt is. So it is not a question of, looking at it, ordinarily as it is. What fundamental or, environmental condition, is the market, going through? You find out that the support level seems to be very, very weak. And we are reporting inflation now, almost at 20%. So what does that mean to, savings and investments? Is it positive or negative? So that's the issue. Relating to the exchange rates of the Naira. Why is the Naira so weak after all these years that we've been using our reserves to support the value of the Naira? So we have so many things, working around and then bringing investments opportunities or investments, downward. Having said that, let's go back to African markets, and I've said the Kenyan market trade in the positive territory, 0.10%, because the investors have returned to the stock markets after the general elections, and they are happy with what they have seen. The same positive trend we see in South Africa. South African market closes 0.96%, almost 1%. Many of them are buying government bonds and equities. The economy is, gradually getting up after the coronavirus and other things. You know how deep it was, pressure. In Botswana, market is also positive, 0.36%. So you can talk about market recovery in many of the African stock exchanges, including Nigeria. So that's positive. Because the economies right now, they are weak. African economies. So the recovery bit, we see big companies are helping, Then the second half of the year that we are moving, we are not too far away to the end of it. And so companies, factories are beginning to put things together to see how they will do with the sales of their products in the last quarter of the year. So that's reasonable. But the question is, will these exchanges sustain this level of achievement that we've seen? So we wait to see.
Thank you so much, my colleague Effiong Ekop. Do enjoy the rest of your day.
It's my pleasure, Tolu.
All right, Asian shares struggled for direction today as they grappled with worries over global growth following weak Chinese data that knocked oil prices and commodity-linked currencies. The dollar briefly hit a one-week high as investors piled back into the safe haven currency. While the Australian euro and Chinese yuan buckled, Euro Stock 50 futures and FTSE futures both added 0.3%, indicating a strong start for European stocks. But S&P 500 futures and Nasdaq futures dipped. MSCI's broadest index of Asian Pacific shares outside Japan edged up 0.1%, recovering from Monday's losses. MSCI's benchmark index has gained 5% from a year low, but is still down 15%. so far this year. Chinese stocks failed to hold onto early gains as growth concerns remain after data showed economic activities and credit expansion slowed sharply in July, prompting the central bank to unexpectedly cut interest rates. The blue chip CSI 300 slipped 0.1% after dipping yesterday. China slashed holdings of U.S. Treasuries for a 7th consecutive month in June. That's the latest from the U.S. Treasury Department data, released with investors closely tracking this measure in wake of tensions between the world's two largest economies. And between the two largest economies involving Taiwan, China's stash of U.S. government debts dropped to $967.8 billion in June, the lowest since May 2010, when it held $843.7 billion. In May, the world's second biggest economy had $980.8 billion in treasuries. China's herd of U.S. debt has seen multiple 12-year lows that the last few months. There is an added wrinkle between U.S. and China relations involving Taiwan, ourselves, and a governed island. China claims as its own, but that is not reflected yet in the data, which covers the June numbers. Earlier this month, U.S. House of Representatives Speaker Nancy Pelosi visited Taiwan, the highest level of U.S. official to visit the territory in 25 years, prompting China's outrage. Barclays lowers its benchmark as Brent price forecast today by $8 per barrel for 2022 and 2023, as it expects a large surplus of crude oil over the near term due to resilient Russian supplies. The British Bank now sees Brent crude averaging $103 this year and next, and U.S. West Texas Intermediate to average $99 for both years. The recent move lowers in prices is primarily a timing issue, as resilient Russian supplies before the European Union sanctions kicks in later this year have coincided with elevated concerns of a broader slowdown, the bank said in a note. EU leaders in late May agreed to impose an embargo on Russian oil imports that will take full effect by the end of the year and will ban all Russian refined products 2 months later. Well, the oil prices on the international market fell today as bleak economic data from top crude buyers China renewed fears of a global recession. A U.S. West Texas Intermediate crude recorded a price dip of 0.74% to hit $88.75 per barrel. Brent sells at $94.15 per barrel, registering a downward price margin of 1%. Bonnie Light's performance continues with its trading value of $118.10 per barrel, with a 3.25% drop in price for the OPEC basket. Crude oil dealers offer $103.20 per barrel, with a price uptick of 1.89%.